Alrighty, there's a lot to talk about today. Let's get started. Good morning, good morning, good morning. Good morning, guys. My name is Sean Dexter and I welcome you back to the Mango Grow for a daily Bitcoin and market analysis. We have Bitcoin's monthly open, brand new month, and the FOMC meeting coming up in just a few hours. And the interplay between everything that's going on the charts at the moment is super exciting. Bitcoin has officially claimed the monthly 10 SMA. And just to put into context how important this is, I want to go ahead and remind you guys that the last time Bitcoin was living above the 10 SMA was over here, guys, all the way back in December 2021. And if you guys do remember, back then I had kept saying all I want for Christmas is for Bitcoin to close above the 10 SMA. And what did we do? We lost the 10 SMA. We closed underneath. And what was the play after that? If you guys do remember, what was the play? Once you lose the 10 SMA, you look for the move down to the 10 kin 21 and EMA juncture, right? Bitcoin did exactly that. It was step by step. The entire way, it was step by step. Consolidated, broke, closed underneath the 21 EMA, and that was lights out for Bitcoin, right? Well, now, finally, after months, Bitcoin has done step one, closed above the monthly 10 SMA. This is huge. This is pretty huge. And there's going to be a lot of eyes on this. And guys, I'm going to be honest with you. I really wasn't holding my breath for this. I really was thinking to myself, man, if Bitcoin actually closes over the monthly 10 SMA, it's going to be ridiculously similar to 2019, especially the psychology of this entire structure and the impulsive move to the upside. So far, it's like a one-to-one repeat of what happened in 2019. And I traded 2019, right? If you guys remember, it's very akin to 3K being in this region. And we took the play all the way up to the Tenkin Kijun back then as well. And now, are we getting the same trade all over again? Is it going to be that easy? Every time, historically, when I've said it can't be that easy, it actually does end up being that easy. Even here, guys, look at this. The break underneath the 21 MA, boom, break down, right? Losing the 10 SMA, boom, that was the end of your bull market. It usually ends up being that easy, right? So don't overcomplicate things. Keep it simple. And in regards to how similar this is to the 2019 psychology, I'm going to go ahead and show you guys what I posted on our Discord just like around 2 weeks ago, around 12 to 13 days ago. So what you guys are seeing over here is essentially a screenshot of our conversation in our Discord chat, right? And I'd essentially posted the price action all the way back from 2019. Okay, you guys are going to see how similar it is to the price action today. We had an impulsive move all the way from 3K, this was 3K zone, impulsive move into the 5K region, and then we consolidated sideways like this, right? Upwards to sideways. Well, I also have what we have currently done. We have our impulsive move from the 16K to 17K region into the 22K region, and we've been consolidating like this sideways, right? Now, what I posted on Discord was like, guys, what's important to understand over here is the psychology of what happened. This is how price moved from one time frame to the other. You have to respect each time frame's levels before looking for the next time frame. Because I remember this vividly. I remember getting shooken out over here of half of my trade, and I was forced to get back in when I realized that, damn, wait a minute, the 12 or 21 EMA is still being defended over here. The trend is still intact. We had an impulsive move of the higher time frames, yet now that has changed the trend on all the time frames, right, including the mid time frames. And at the time, I didn't have the Mango dashboard, so I wasn't able to look at all the time frame trends together and say, hey, wait a minute, I need to respect the 12 hour as well. It was only after the fact, so I remember this vividly. That's why I posted this to you guys saying that, hey, the 12 hour 21 EMA to the 1 day 21 EMA 4 years ago, markets don't repeat, but human emotions do, because that's what price action is, guys. It's the ebb and flow of human behavior and emotions. You guys can see what we did. We had the impulsive move, consolidated like this, came down. Everyone expected a deeper move. Everyone. I remember this clearly, but instead we got support on the 12 or 21 MA, grinded up. Everyone gave up, and then we got the deeper move to the daily 21 EMA, right? Let me just go ahead and erase all of this. You see this little wick over here? What we're looking at, by the way, is the 12-hour time frame, okay? 12-hour time frame. This wick over here, this move down here, it actually came down on over to the daily 21 EMA, and then price took off. Price took off from here, from 5K all the way to 14K, right? So that move down to the daily 21 EMA, it did come. But it only came after we first respected the 12 hour 21 EMA, grinded up, and then broke down, right? So I want to show you guys what we're doing at the moment. Let me go ahead and erase all this. We had an impulsive move off the high time frame consolidation, just like what we did in 3K, grinded upwards like this. Everyone expected a deeper move, right? But instead, we got supported on the 12 or 21 EMA. Now, I want to emphasize, I'm not saying that the deeper move won't come. I'm just saying that you have to respect each level before looking for the deeper level move, right? Look at what happened all the way back in 2019. We got respected on the 12 or 21 EMA, grinded up, and then got the deeper move, right? Well, I think something similar is bound to happen. When does it happen is the big question. Does it happen now or at a much higher level? For example, we could go all the way up to, let's say, 30K and then get the deeper pullback on over to the 21 EMA. Either way, the first test of the daily 21 EMA after an impulsive move is usually a bid. Just like how the first test of the 12 or 21 EMA after the impulsive move is usually a bid. But the daily 21 EMA is a more high probability bid. When does it come though? Does it come now? Does it come at around 25K? If we actually grind to around 25K and then have a deep pullback to the daily 21 EMA, right? That's going to be very similar to 2019. And again, I just fail to see how we get such a exact repeat. So just keep the ebb and flow between timeframes at the back of your mind, guys. And we will be going over the volatility and trend profile on the dashboard very soon. So that's going to help us make sure that we're not making any stupid decisions as well. Now, what I don't want you guys to do, okay, and for God's sake, do not do this. Don't go all the way back to 2019's price action and try to draw it one-to-one and expect price to behave exactly the same way. I've seen far too many traders try to do that. They try to play fractals one-to-one and they get wrecked. What you are looking to do is understand the dynamic nature of markets while knowing that human emotions don't change, okay? Human emotions may get more erratic, more frantic, and may happen at a faster pace, a slower pace, but the ebb and flow is usually the same. And today, we are seeing something very similar, right? And this is just on the mid time frames that I'm showing you guys over here. I'm showing you guys the 12 and the daily, right? We are seeing very similar price action on the monthly as well in regards to the momentum and the market emotions. I've been posting this monthly stochastic charts to you guys now for a while, right? For like a few months, I've been saying that, hey, every time the stochastics have bottomed out over here in the lower region and then have crossed bullish, that has lined up with the beginning of macro bull markets. And again, I want to remind you guys, a macro bull market does not equate a parabolic bull market, right? These two are two different things, right? A macro bull market is your slow grind that could have deep pullbacks and then it leads to a parabolic run, right? Just like over here in 2015, a slow grind, and then we had the parabolic bull run. Anyways, going back to what we were saying, what we've identified is that each time the stochastics have bottomed and crossed bullish, it has lined up with the beginning of a macro bull run, right? Happened in 2011, in 2015 as well. Crossed bullish over here at the bottom, and it started its move at around $200 to $300 right over there. In 2019 as well, right over here, crossed bullish, and then started its move right over there at around 3K to 4K region, right? And now we've been waiting for this cross over here in 2023, and what do you know? It's lining up. So now, not only do we have a monthly 10 SMA that we can check off, but we also have our monthly Stokes that have now triggered as bullish as well. But does that mean that we're just going to go straight up to $200,000 from here? No, of course not. Remember, this is only the beginning of a macro bull market that's going to have ebb and flow on the monthly time frame, guys. We could have deep pullbacks. In fact, let's go back on over to our monthly chart right at the start of this video, okay? We're going to go ahead and erase some of this mess over here, and I want to show you guys how Bitcoin still has a lot of work to do, okay? Just because we've claimed the 10 SMA doesn't mean that we are back on over to the same bullishness that we had all the way back over here in 2020 October, or even over here in around April 2021. It's nowhere similar. You know why? Because we have a lot of resistance overhead, a lot of work that needs to be done, a lot of resistance that needs to be claimed. The monthly 21 EMA is overhead, the Kijun is overhead, and the monthly Tenkin is overhead. As long as we have all of these guys overhead, we cannot get too excited. And remember, the weekly cloud is still red, right? I told you guys that as long as the weekly cloud is red, you do not look for your parabolic bull run. But that doesn't mean that there aren't opportunities while the weekly cloud is red. It doesn't mean that you should simply not trade while the weekly cloud is red. You can have massive wins while the weekly cloud is red. In fact, guys, when I look back at my trading history, most of my victories, my big victories have come while the weekly cloud was actually red. That's when you accumulate all of your favorite coins, whether it be Bitcoin, Ethereum, Cardano, Matic, whatever it may be, right? That's when you can accumulate the most because the trading opportunities are actually the best. You can actually trade pure TA, put in the hard work now. Don't wait for the bull market. In the bull market, you want to sit back and let the parabolic run carry you for the final stretch of a 5x or a 10x. Now, even if you can 2x your entire account or 3x your entire account, that's going to be a massive win because when the bull market comes and then it suddenly goes 5x or even 10x, well, your 2x has turned into a 20x. Your 3x has turned into a 30x, right? So put in the hard work now. Right? It's going to be easy right now in the bull run. Believe me, the emotions, you are your worst enemy when it comes to the markets, guys. And in the bull run, the emotions will get the better of you if you are too active in the markets. I like to sit back and let the markets carry me to victory in the bull run. I don't like to overtrade in the bull run. Now, this is the time where I'm trading the most. Okay, with that aside, there's something I do want to go ahead and quickly emphasize to you guys. Okay, I want you guys to focus on the 10 SMA, okay? Notice a few things about it. One, it's sloping downwards, okay? The slope is downwards. Until it actually starts sloping upwards like this, you cannot get too bullish even on the macro. It's great that we have claimed the 10 SMA, but we want to start seeing it sloping upwards. And that's only going to happen if you get a couple more candles closing above the 10 SMA. What you're likely going to be seeing very, very soon is a test of that 10 SMA if the bulls hesitate around here, right? If you don't see a big move towards the 21 EMA and claim it, you're going to see that 10 SMA get tested. That is likely going to be another opportunity to be bidding, especially if it lines up with the 21 EMA, right? Currently, the monthly 10 SMA is now sitting at $21,500. That's already $500-ish, guys, less than what it was last month, okay? The last month, the 10 SMA was sitting at around $22,000. So it's coming down, right? We want to start seeing this ticking up. You could simply use the slope of the 10 SMA as a guide as to whether or not we are leading into a macro bull run or not. We don't have that checked off yet, right? But remember, this is a bit of a lagging indicator. Looking at the slope of the monthly 10 SMA, it's still something though that you should be keeping an eye on. So two things: 10 SMA still sloping downwards, and 10 SMA might get tested, so be patient for that. I'm gonna go ahead now and quickly talk about the dashboard volatility profile over here. I have pasted for you guys the 4-hour, the 12-hour, and the daily. And what are you guys noticing? What are you guys noticing? We are now seeing the exact picture I would love to see on the trend profile across the time frames, right? A few days ago, I think it was 3 or 4 days ago, here's a screenshot of the profile from a few days ago, and I'm going to quickly place it over there so it's not too messy. And I'm just showing you guys this for reference, and I'm going to quickly hide it again. But the point I'm trying to make over here is that a few days ago, the volatility was red on the daily and on the 12-hour, right? On the 4-hour, it was orange. And I said to you guys that even though we are long across all time frames, I would much rather us be short on the 4-hour, right? Right over here, you can see, rather us much be short on the 4-hour and long on the 12-hour and the daily, provided that we have low volatility. Look at these two blue arrows here. That's me saying that, hey, I would rather us have low volatility on the high time frames, even if that means us going into a short trend on the 4-hour time frame, right? Because that's what it's going to take. It's going to take the 4-hour going into a downtrend consolidation or even sideways consolidation for the volatility on the daily and the 12-hour to actually turn blue, right? In fact, I would have been happy even if it was in the upper 50s. And what are we seeing now? Now we are seeing exactly that, right? We are seeing that the 4-hour trend has turned short. And when you think of a short trend, what are you thinking? You're thinking of movement like this, correct? Well, that's what we have on the 4-hour, but the 12-hour and the daily are both long, right? And when you're thinking daily and 12-hour, what are you thinking? You're thinking an uptrend like this, right? Well, guys, when you look at this to a bigger picture, that's your bull flag. That's your bull flag right over there, right? Your long trend on the higher time frames and your short trend on the lower time frames. But now you have decreased volatility on the 12-hour. It's sitting at blue. We also have the Ichimoku bullish call over there. On the daily, you have your volatility compressed to 8 single digits. Ichimoku call and bullish divergence as well, and we'll be talking about this bullish divergence down here soon. But what we're seeing over here now on the trend and volatility profile for Bitcoin is precisely what I'd want to see for that next leg to the upside. For the past like week or so now, I've been saying be cautious, guys, be cautious. We have weekly resistance overhead, right? We also had monthly 10 SMA overhead. We had far too many things that were going against us, along with high volatility on the higher time frames, right? On the daily and the 12-hour, we had red volatility. All of that was making a lot of traders uncomfortable to put on positions, but all of that started changing recently. If you think back to a few days ago, we claimed the weekly resistance, and then the volatility on the 12-hour and the daily started reducing, and now the monthly resistance is kind of out of the way. The reason I'm saying kind of out of the way is because that 10 SMA, the way it's sloping down and the way the monthly is so close to it, it just kind of feels like we may want to wick back down, retest it. I want to see that retest. I'd feel a lot better if Bitcoin can come down, test it, and then bounce up off it. That would give me as a trader confidence, right? I would want to see the market bidding that monthly 10 SMA that we were just looking at. But again, we have weekly out of the way, monthly out of the way, and volatility coming down as well. Let's go ahead and talk about what's going on over here on the bullish divergence. Okay, remember, bullish divergence triggered on the dashboard. By the way, guys, I've been getting questions on whether we can use this volatility analysis for other altcoins as well. And yes, of course you can. And not just crypto, you can use the same analysis for all assets, right? Traditional commodities, etc. It works the same way. Okay, let's go ahead and talk about this bullish divergence that we're seeing over here on Bitcoin. This bullish divergence is getting pretty aggressive. We're looking at this point over here. Bitcoin was sitting around 19,900-ish, and this point over here, right, from a couple of days ago. Now, you guys can see that Bitcoin has put in a higher low on price, but on RSI, between the same points, Bitcoin has put in a lower low. Now, remember, this is not confirmed just yet. This bullish divergence will get triggered when we take out this high right over here, coming around 23,320. So look for price action around that area. If you start seeing the market all put on bids around, one of my triggers just got triggered. I'm not sure if you guys heard that, but yeah, if you see the market take out that high, I'd watch for price action after the fact. So for example, if you see a slow grind on the daily time frame upwards like this, in that case, I'd be looking for a bigger leg towards the upside, perhaps taking out those higher time frame resistances overhead. However, if you see the market take out the high with a volatile move almost immediately, especially if it happens in the next day or so, I'd be on guard for that, especially in regards to FOMC shenanigans, because you are going to see some volatility leading up to the FOMC meeting, right? You're going to have the lower time frame traders and the higher time frame traders at odds with each other. The lower time frame traders are going to be trying to play the volatility, and the higher time frame traders are going to be putting on positions for the next months and perhaps even the year to come. Okay, so with that, actually, we can move on to the FOMC meeting coming up today. By the way, if you guys have been enjoying this content, please let me know in the comments down below. Putting together these slides are really, really time consuming and take a lot of effort. So your comments have been super motivating. And hey, if you guys are new to the channel, show Mango some love by hitting that like button and subscribing to the channel. All right, so what we're looking at over here, guys, is the target rate probabilities for the FOMC meeting coming up very, very soon. This is essentially a visualization of what the market thinks the Fed is going to be doing in today's meeting. So at the moment, the market is placing a 97.7% probability that the Fed raises interest rates by only 25 basis points. And 25 basis points, by the way, is simply 0.25%. All right. So for the past few months now, the Fed has been increasing rates by 75, 75, 75, 50, 50, 50, right? They've been pretty aggressive. Now we suddenly have a change in what the market thinks the Fed is going to do. Okay, the market thinks that the Fed is not going to be raising as high as they have been. They're going to be increasing by only 25 basis points. And the overwhelming majority of the market thinks that the Fed is going to be increasing rates by only 25, right? In fact, you guys can see that only 2.3% of the market thinks that the Fed is going to actually put in another 50 basis points hike. This is really, really important, okay? Because if the Fed actually comes out and gives a 50 basis points hike, it would mean that 97.7% of the market got a hike that they did not expect, right? A 50 basis points hike would be an unexpected move to the downside. It would be a hawkish move, right? So there are two unexpected outcomes at the moment. There is a 50 basis points outcome that would be completely unexpected, and also a 0 basis points outcome that would be unexpected, right? A 0 basis points hike is essentially the Fed coming out and saying, hey, we're not going to be raising rates at all. We are staying flat. We are doing nothing. If the Fed actually comes out and says that they're staying flat, the market's actually going to take a nice move to the upside. However, if instead the Fed comes out and says, hey, we're actually going to be increasing rates by 50 basis points, well, that would mean that 97.7% of the market did not expect that, and the markets are going to have to take a big leg towards the downside to reprice for a 50 basis points hike instead, right? Now, I do think that a big move towards the downside is still going to be a bid opportunity, because if we get a 50 basis points hike, it's likely the case that the next meeting the Fed actually does come out and say 0 basis points, right? So I think a big leg towards the downside will be a overreaction, right? And that's only going to set up for a long-term bid for the macro bull market that we've been talking about, right? So there are essentially three outcomes for today's FOMC meeting. The Fed can come out and say, hey, we're staying flat and there's going to be a 0 basis points hike, okay? Or they can come out and say, hey, you know what, we're increasing rates by 25 basis points, right? Not too high, but we're still increasing. And then they can come out and say, you know what, I know you guys have been expecting only a 25 basis points hike, but we're going to go ahead and raise by 50 basis points. Now, the market thinks that there's a 0% chance of the 0 basis points hike, that there's a 98% chance of the 25 basis points hike, and there's only a 2% chance of the 50 basis points hike. What's really interesting is that over the past couple of weeks, the market was pretty firm on the 98% on the 25 basis points, right? This has not changed all that much. However, the market has been swaying and deliberating between, hey, is there a small probability we get a 0% hike, or is there a small probability we get a 2% hike? Now, this close to the meeting, it seems like the market has decided that, you know what, a 0% hike is just not possible at the moment. Instead, we actually may get a 50 basis points hike, right? So this has gone up while the 0% has been completely gone away, right? This may actually be due to what's been going on in the equity markets. We've been seeing the equity markets rally and the bond markets rally as well. And this, as I've been saying to you guys for the past few weeks now, is not what the Fed would want to see. Because when the Fed actually sees this, they are going to be like, wait a minute, financial conditions are loosening again. Because remember, guys, when equities go up, people feel richer. When people feel richer, they go out and start buying things. When bonds go up, what happens? Yields come down. When yields come down, mortgage rates come down. When mortgage rates come down, people go into their house fever again, and house inflation goes up as well. And at the moment, the Fed wants to control inflation. That is their main goal at the moment, right? They do not want inflation to get out of control. So market participants might actually be looking at what the equity markets are doing and saying, hey, you know what? Based on what the equity markets are doing, the Fed may actually come out and give us a 50 basis points hike just to put the market in their place, just to prove a point that they mean business in regards to inflation. Now, here's the thing. Personally, I don't think that we're going to get a 50 basis points hike. I think we're going to get the 25 basis points hike. However, I think the Fed is going to talk really tough. Remember, there are two parts to these FOMC meetings. There's the actual rate hike that will be announced, and then there's the press conference where Jay Powell is going to come out and give a speech. Now, both of these are tools to sway the market. The rate hike is immediate action on the markets, while the press conference is the Fed's forward guidance, where they're telling the market, hey, this is what we're going to do. So you guys better not be surprised when we do it. Now here's the thing. Even if Jay Powell comes out and talks tough, the market might be saying, hey, we don't believe you. We are calling your bluff. We think that you're going to soften soon. We think that you're either going to go flat, or we think that you may actually be decreasing rates soon, right? And I've actually gone ahead and jotted down some quick notes on some key talking points that Jay Powell is going to be targeting, and what the market currently is going to be targeting as their counter narrative to what Jay Powell will likely be talking about in today's meeting, right? And now there's no real surprise over here, guys, because these have been the main talking points for Jay Powell for a few months now, right? But I'm going to go ahead and explain it for you guys anyways, because some of you might be new to the whole macro scene, right? One of the points you're going to hear Jay Powell press on is that they're going to stay firm on their stance until they get inflation rate down to their target rate. In fact, this is wrong here. It should be the other way around. The inflation rate at the moment is currently higher than the target rate. The Fed targets a inflation rate of around 2%, right? And at the moment, CPI is way higher than this. Fed is going to be pressing on this point. They're going to be saying, hey, inflation is still not at our target rate. We are going to be keeping firm until we get inflation down. They're also going to be pressing on employment, guys. If you guys remember a few months ago, and this was way before the Fed was focusing on employment data, I had done a specific video where we talked about wage inflation and how employment is going to be a talking point in the coming months, right? Well, that talking point is now at the forefront of this current debate. Employment being strong leads to wage inflation. Wage inflation leads to price inflation. Price inflation leads to a demand for wage inflation. Further wage inflation leads to price inflation. Price inflation leads to wage inflation. This here is your inflation spiral, right? So the Fed is going to be pressing on this point as well. As long as employment is strong, as well as the inflation rate being above our target rate, we cannot ease just yet. We need to stay firm until we get the problem completely solved. So the Fed is essentially saying we want inflation to come down, and failing that, we want employment to come down to force inflation down. Right? Because if employment goes down, the Fed can push the market into a recession, and a recession will essentially take care of inflation. Now, on the other hand, the market might be saying, wait a minute, inflation has been coming down over the past few months, and we know that you guys have two mandates. One, you have to control inflation, make sure prices don't get out of control, price stability essentially, and two, you also have to ensure high employment, right? Now, we already know that we have high employment. The Fed has been talking about it for the past couple of months. Employment is strong, but inflation is out of control, right? However, inflation has been coming down over the past few months. So this means that the Fed has been able to manage both of their mandates without causing a drop in employment. And that essentially, guys, is called a soft landing. And this was actually something that was not considered by the market whatsoever around 6 to 8 months ago. Everyone thought that the only way the Fed could rein in inflation was by bringing employment down. Everyone thought that we are going to go into a recession and everyone's going to lose their jobs, because the only way you can control inflation is by people losing their jobs. Well, employment has stayed high and inflation has been coming down. So the market now is pricing in a possibility of a soft landing. This is what is called a soft landing. A hard landing is when you get inflation down by also bringing employment down, right? You land hard, everyone loses their job. So that's one of the arguments for the market at the moment, that, hey, you know what? You guys may actually be getting your soft landing. So there's no reason to keep raising rates. There's no reason to stay on your hawkish stance. You guys can start pivoting very, very soon. On the other hand, another side of the market is saying, you know what, even if you guys do raise rates, even if you guys do stay flat, we think you're going to put the market into a recession. Yes, people haven't lost their jobs yet, but it's coming. Just give it time. A recession is coming. So if a recession does come, you guys can't possibly stay on your rate hiking cycle, right? There's no way. You guys will have to soften. You guys will have to cut rates, right? So the market has two narratives for a Fed pivot or a Fed flattening at the very least. While the Fed is going to be coming out and talking tough, saying that, hey, you know what? We are going to keep going. And the market is going to say, yeah, if you keep going, you're going to push your market into recession. While another part of the market is saying is, yeah, we're calling your bluff. You got your soft landing. You got exactly what you wanted. You have two mandates, inflation under control and high employment. Well, that's what you got. So today's press conference is going to be especially interesting to see how Jay Powell navigates this. All right, guys, I actually have more slides for you guys, but we're going to have to wrap it up over here. I think we're already at the 30-minute mark now. Damn, today was a long video. I hope you guys enjoyed this one. Let me know in the comments down below. Your comments and your likes have been what keeps me going on these daily videos. So until the next one, do the mango way, do the easy way, do the stress-free way. Ciao.